Good morning. Welcome to the 12th lecture on economics, management and entrepreneurship. Today, we shall discuss about double entry bookkeeping system. This is a very popular method of keeping accounts and is widely used in industries and in all forms of business, and it is highly relevant to even a new entrepreneur. So, we start the discussion on double entry bookkeeping systems. First of all, as we had been doing every time, we are first of all giving certain definitions or explanations of a few terms. First of all, the word entity we shall use quite often to indicate a specific area of accountability requiring a clear cut boundary for reporting, such as a firm. A firm could be an entity for whom accounts are to be kept. Transaction. By transaction, we would mean any event that changes the financial position of an entity. Later on, we shall give a large number of examples of transactions, and we shall say how they influence the financial position of an entity. Bookkeeping. Bookkeeping basically means recording of business transactions. Whenever a transaction takes place, it has got financial implications, and these transactions and the financial implications are to be recorded in books of accounts and are known. This process is known as a bookkeeping process. Next, we define a word entry. Entry would mean recording in the books of accounts in respect of a transaction. Every entry that is made in a book of account refers to a particular aspect of a transaction, and since the topic is double entry bookkeeping, we would try to say that for every transaction there will be two entries. That is double entry. It says two entries are made for every transaction and not one. We shall explain in great detail the meaning of the word double entry. Now, in this slide we are giving an example. Let us say that whenever money is transacted, there is a receiver whose amount of cash increases and there is a giver whose cash position decreases. So, you can see that for a transaction which is cash changing hands, actually two sub transactions are involved requiring true entries. We shall call the person who receives the money as a debtor, and a person who gives the money is a creditor. So, this word debtor and creditor has got wider ramifications, and we will discuss that in many examples that will follow. Let us say this is one example that we are saying cash is paid by the firm to buy 2 chairs. Now, in this case the total amount invested in chairs increases. The firm purchases chairs, therefore, the inventory of chairs in the firm increases, whereas cash is given out to the supplier of chairs and therefore, cash position reduces. So, in this case the cash position reduces, that is something like a giver. So, it is whose amount decreases, therefore, it is credited to cash account. In the language of an accountant, it is called the amount is credited to cash account, whereas the receiver is the chairs account, because the number of chairs and the money involved in it increases in the chairs account. So, therefore, it is a receiver whose amount increases, and in the language of an accountant, this is called the amount is debited to chairs account. So, sometimes the term DR is used for debited and CR is used for credited. Now, we will in our next slide say the historical background regarding the use of the short form DR and CR. In fact, this should be DR dot and CR dot. DR dot and CR dot. DR for debited or debit, CR for credit. Now, here we are talking about the form of an account. Just one second. Yes. When an account is kept for a particular asset, there is a debit side and there is a credit side. Like I said before, it should be DR dot and CR dot. Now, normally these data are kept on the debit side. We have the date in which a transaction takes place, the explanation of the transaction and the amount transacted, and CR is date, particulars of the transaction and the amount. So, for every account these details are kept. The left hand side is called the debit side and the right hand side of the account is known as a credit side. Now, there can be different types of account. There could be personal accounts or could be impersonal accounts. Personal account means the debtors, the creditors, the capital account of the owner. So, in the name of particular persons, or it could be impersonal, like in the real accounts such as the assets of the firm like land, buildings, cash, etc., or it could be nominal accounts such as expenses, losses, gains and revenue. We shall later show that for all real accounts and for all personal accounts, the debit sides total equals the credit side equals credit side totals, whereas for nominal account it is not so. This helps, these accounts help in finding out the profit in a particular period, whereas these accounts, particularly real accounts and also personal accounts, they help in developing the financial statements of a company. These details will be discussed in the future. Now, let us discuss what is the historical background for the word debit and for the short form Dr. dot. The usual definition of debit is that it is the left hand side of an account. Now, the word has a Latin origin. The Latin verb from where this word is derived is debere, meaning to owe. Its past particle is debitum, that which is owed. From there, the French term is debit and the English term is debit, spelling D-E-B-E-T and D-E-B-I-T. Now, historically, this term, because it is debere, it is Dr. dot, and this actually this double entry bookkeeping system was developed by a Roman Catholic monk, and he used the word debere, and from there he used debitum and then Dr. dot. So, today we are using debit and Dr. dot. So, a debit increases the value of an asset, but it decreases the value of a liability. So, that is we will talk about the meaning of asset and liability in some more detail later, but for the time being let us understand that a debit increases the value of an asset, but reduces the value of a liability. Sometimes the word charge is also used in place of debit. Now, the word debit can be used as a verb or as a noun or even as an adjective. These three sentences are examples. As a verb, we may say debit the amount to cash account. We can say as a noun, a debit is made to the cash account, or we can use the word debit as an adjective, like saying cash has a debit balance of rupees 25,000. So, this is verb, this is noun and this is adjective. So, basically if the account is for an asset, a debit side increases the value of the asset, but if the account is for a liability, the debit side reduces the value of the liability. Now, let us look at the origin of the word credit. This also has a Latin origin, and this is usually, this will indicate the right hand side of an account. The Latin verb is credere, past particle is creditum, that which is entrusted or loaned. The English word is credit from creditum, and in abbreviation we say Cr dot. This is the historicity of the word credit. A credit decreases the value of an asset, but increases the value of a liability. It is just the opposite of the debit side of an asset or of a liability. With this, now let us go to some other term. A new term now we are introducing, that is journal. Journal is the book in which entries are recorded one after the other, date wise, various entries for various transactions, the entries are made, and this is also known sometimes as the book of original entry. Whenever a transaction takes place, the first thing to be filled up is the journal. On this day, this is the transaction, and every transaction has got two aspects. Two entries are made. One is, it says, suppose that the material is bought on payment of rupees 20,000. So, material is bought. So, either it is purchase account or inventory account, it increases by 20,000, but payment of cash has been made for 20,000. Therefore, cash reduces, both are assets, and therefore, increases meaning that this is in the debit side, purchase increases or inventory increases, the amount is written in the DR column, whereas cash reduces because cash has been paid. So, cash reduces, therefore, this amount appears in the credit column. Two entries have been made. Suppose after some time another transaction takes place, there will be two more entries and correspondingly they will be written here. This is called a journal. So, journal basically contains various transactions that take place, entries for various transactions that take place. Two entries are made for every transaction, and particulars, date and the amount debited or credited are written down. Next, we talk about ledger. This is also another new term, and this basically contains various accounts. Basically, if you recall, a journal contains various transactions, and it says for every transaction which accounts are going to be affected. And by the way, we had already said what an account looks like. Basically, an account is for a particular item, let us say cash. For cash on different dates, we write down entries here and here. This is for every particular entity or account we maintain. We maintain an account for every particular asset or liability, whereas a journal says for every transaction different accounts and their explanations and the amounts are mentioned here. This is the book of original entry, and in a ledger basically from the journals that we have mentioned here, various accounts are maintained. The entries in the journals are posted onto the ledger. Say for example, in our let us say that this is also known as the principal book. It contains various accounts, both personal and impersonal. Say the transaction is raw material is bought on payment of rupees 20,000. The ledger accounts, various accounts are kept in the ledger. They look like T, and therefore, these accounts are also known as T accounts. So, we may have an inventory account here or a purchase account here. Inventory account we are writing, it is raw material. So, inventory account and cash account. Now, here inventory and cash both are assets, and for every account there is a left hand side which is DR, the debit, and the right hand side which is credit. Cash account also debit and credit. So, when raw material is bought, the raw material position increases, therefore, this increases by 20,000, and cash account, cash position reduces, therefore, this amount is credited to the cash account. Now, there is a cross reference that this amount 20,000 refers to also the cash account. Therefore, we write to cash account 20,000, and when we are maintaining the cash account, we also give a reference to inventory by writing inventory account 20,000. So, this is how there is a cross reference between the accounts. So, three things. One is the journal, where on every date as various transactions take place, the two entries are made indicating different accounts where the entries have to be basically posted. And finally, maybe at the end of the day, from the journals to the ledger different individual accounts, the entries are basically posted in this manner. There is a cross reference, as you can see. The amount is written on the left hand side for debit, and for the credit also amounts are written. Now, in any account there is always a first entry, that is the opening balance. The opening balance in an account in the beginning of a new year is the closing balance of the account in the previous year. So, say cash position in the year 2011, March end cash position was something. So, when 2011-12 financial year, April 1st, the first entry will be the closing balance of the previous financial year, and that is called the first entry. And there we sometimes write balance brought down, or BAL dot B by D. So, it is written both in the debit side for assets and for the credit side for liabilities, to balance brought down. Now, we are giving an example of how to maintain an account. Let us say that Hari, an entrepreneur, opened a new hardware shop by investing rupees 1 lakh. So, this is the amount he pays from his own funds. Now, in the first month of operation, there were, we are assuming, only 4 transactions. There will be many transactions, but for the sake of an example, we are assuming that there are 4 transactions. He bought furniture worth rupees 20,000, first transaction. He bought goods worth rupees 50,000 with rupees 30,000 on credit and the remaining amount on cash. So, 50,000 is the amount of goods he bought, but he paid only 20,000 and 30,000 he promised to pay later. So, he bought it on credit. Out of this 50,000, he sold material worth rupees 7,000 for 10,000. It means that out of this 50,000, he bought some material which he bought for 7,000 rupees, but he could sell for 10,000 rupees on cash payment. So, making here a profit of 3,000 on the items worth 7,000 that he had bought. Now, you recall that he had not paid 30,000 rupees to the supplier of the goods. Now, he pays back 10,000 rupees to the supplier. Now, there are thus 4 transactions, and how Hari would keep his accounts by following the double entry bookkeeping system. Let us see that here. First of all, let us understand that he pays from out of his own money 1 lakh rupees to start the business. So, that is reflected in the form of cash. So, cash increases by 1 lakh rupees. and there is a cross reference to the paid in capital. Paid in capital is the amount of money that the entrepreneur Hari has invested when the business started. That is usually called the paid in capital. Now, as far as the company is concerned, or this particular entity, the hardware shop is concerned, this will be considered as a liability to the shop, because it is Hari's money and not the hardware shop's money. Hardware shops own 1 lakh rupees cash, but it owes that money to Hari. So, the paid in capital is basically something like a liability, and that increases. So, if it is a liability, the credit side says that it increases. So, the entry is made here in the right hand side of the T account as 1 lakh, whereas cash increases. Cash is an asset of the hardware shop. Therefore, the entry is 1 lakh rupees is debited to cash account. So, this is the first thing to note, that Hari, the entrepreneur, and the hardware shop, the entity for whom we are writing the accounts, they are two different things. They are not one and the same. This has to be understood right at the beginning. Now, each transaction let us understand. The first transaction was that Hari bought furniture worth rupees 20,000. That means, he paid 20,000 rupees from his cash and he got the furniture. Therefore, the cash position will come down, but furniture position will improve. So, we have a furniture which is an asset, cash is also an asset. So, the first transaction, this one is transaction number, this is transaction number. So, instead of following the convention that we had introduced earlier, we are now putting the transaction number, this is also followed. So, we are saying the cash position reduces, cash is an asset, its value reduces, therefore, the amount 20,000 is credited to cash. So, if it is an asset, credit side will reduce, but furniture is also an asset, its value increases, therefore, this amount is debited. So, two entries are made for the first transaction. Now, let us look at the second transaction. Second transaction is not so straightforward. It says he bought goods worth rupees 50,000 with rupees 30,000 on credit and remaining amount on cash payment. So, cash payment of 20,000 has been made, therefore, cash position will come down. Therefore, this amount of 20,000 would be credited to cash, because cash is an asset. Goods is basically an asset. So, goods inventory increases, therefore, this 50,000 rupees will be debited to goods, whereas this amount he has not paid, this is to be paid later. So, this is called accounts payable, he has to pay it later. This is a liability. The liability has increased from 0 to 30,000. When it is a liability, the credit side increases. So, this 30,000 rupees will be credited to accounts payable account. Let us show this. Number 2, he bought goods worth 50,000 rupees. So, transaction number 2, 50,000 rupees is debited to the inventory account. This is the T account. 50,000 is debited. payment of cash is made by 20,000 rupees, cash payment. Therefore, the cash position reduces, cash being an asset, and since the value reduces, the entry is made in the credit side. Whereas, this payable, accounts payable has also gone up, and this is, there is a mistake here. This 30,000 should go there. This should, yes, the payable has gone up by 30,000. Therefore, the entry is made in the credit side, because payable is basically a liability. This has to be paid back. So, it has gone up, therefore, the amount is credited to accounts payable account. Now, let us look at the third entry. The third entry says he sold material worth 7,000 rupees for 10,000 on cash payment by the buyer. So, the buyer has paid 10,000 rupees, which means his cash position has gone up, but the cost of goods sold, this is COGS. The cost, the goods that he has sold, he had bought only for 7,000 rupees. So, from his inventory of 50,000 rupees, 7,000 rupees will be less. These are the minimum two entries that must be made. Now, let us look at 3. First, the inventory position has come down, because 7,000 rupees worth of goods that he had bought earlier, he was able to sell. So, inventory being an asset, the value is reduced by 7,000, therefore, this amount is credited to inventory, and he could get 10,000 rupees by selling it. Therefore, cash position has gone up. Cash being an asset, this amount is debited to cash in the third transaction. But let us also understand that in the process he has made a profit. Now, this is written down in the expense and revenue account, the so called nominal account that I was saying, impersonal nominal account. This is the expense and revenue account. Now, here we are showing the cost of goods sold as 7,000. This is same as this transaction number 3, whereas he was able to sell 10,000 rupees, it is credited, making a profit of 3,000 rupees. This 3,000 rupees goes here and is shown as retained earning, profit made in the business, 3,000 rupees. Now, why the entry for COGS is on the left hand side, that is in the debit side, and sales on the credit side, we shall know a short while from now. Meanwhile, let us go for the fourth transaction. He paid back rupees 10,000 to the supplier of goods. So, he paid back 10,000 rupees. So, cash position comes down, 10,000 rupees is credited therefore to cash, but at the same time his accounts payable has also gone down. Accounts payable was 30,000, he had bought goods worth rupees 30,000 some time ago without making payment. So, the whole amount was payable, and since it is a liability which has increased, therefore, it is credited to payable, but now with the payment of 10,000 rupees back to the supplier, his payable has reduced. Since payable is a liability, it is debited to this account. So, 4 transactions we have posted like this. Now, these are totals. Whichever is the higher side, we write that side. You will see that assets will always have their debit side as the total amount. So, 50,000 minus 7,000 is 43,000. This is 1,10,000 minus 50 is 60,000. This is 20,000. So, the debit side of all assets are positive after the totaling, and here the credit side of all the liabilities are also totaled and positive. So, this is 1 lakh, this is 20,000, this is 3,000. Basically, this 3,000 comes from the difference between credit side and debit side. Now, from out of these transactions, we write down the trial balance. So, what we have basically done, you will see that the debit balances and credit balances will always be equal. To check this, what we have done is inventory was 40,000, cash was 60,000, furniture 20,000. So, 43, 60 and 20, that is what we have written down here, 43, 60 and 20 for different accounts, inventory account, cash account and furniture account. On the liabilities side, we have 1 lakh, 20,000 and 3,000, not this, because already we have summarized them and posted it here. So, 1 lakh, 20 and 3, 1 lakh, 20,000 and 3,000. When we add them up, we see that they are equal. Notice that the nominal accounts, that is expense and revenue account, help in giving the retained earnings, but do not take part in the above balancing act. So, we have not considered the expenses and revenue account when we create our trial balance. In fact, this is also an example of what we say balance sheet, about which we will discuss later, but just now we are trying to tell you about how for different financial transactions accounts are kept by the or with the use of double entry bookkeeping system. Now, this balancing act gives rise to an accounting equation, which is that the total assets must equal the total liabilities. Now, what we mean by total liabilities? It is the liability such as accounts payable plus the owner's equity. In this case, in our previous example, Hari was the owner. So, basically liabilities is outsider's claim and owner's equity is the owner's claim, Hari's claim. Now, in our previous example, the suppliers were the outsiders and their claim was basically accounts payable, whereas owner was Hari and his claim is the paid in capital, that is of 1 lakh rupees, and the profit that he has made, which he has at this point of time forfeited, is as 3,000 rupees. So, owner's claim in our previous example is 1 lakh 3,000 rupees. That is what we are writing down here, that the outsiders the total assets equals total liabilities, which is equal to outsiders claim plus paid in capital plus retained earnings. So, this is also equal to outsiders claim plus paid in capital plus what is retained earning? It is same as revenue minus expense. So, please recall revenue minus expense, this is the revenue side, this is the expense side. Revenue is sales, expense is COGS, subtraction is 3000 and that is considered as profit and is added to the retained earnings 3000. So, paid in capital is basically the amount Hari has invested initially. So, naturally that is his claim, he must get back. Also, since by doing this business he has got a profit of 3000 rupees, he also has a claim to get this amount. Therefore, owner's equity is the paid in capital plus 3000 rupees. The outsider's claim is to the extent in this case of 20,000 rupees only because the hardware shop has not made payment towards full payment towards buying the goods from the suppliers, that is accounts payable. So, this is outsider's claim and these two added together is Hari's claim, the owner's claim, and these are the assets of the company and all assets together must equal the liabilities plus the owner's equity. That is what we have shown. Now, here the last equation will say that retained earning is revenue minus expense. If you take expense to the left hand side, then you will see that total assets plus expenses become equal to outsider's claim plus paid in capital plus revenue. Therefore, revenue is to be considered like a liability. It has the same positive sign as those of outsider's claim and paid in capital, whereas expense when it goes to this side, this is positive like total assets. Therefore, expense is treated as an asset. Therefore, our rule for debit and credit will apply accordingly. Recall that for asset, if its values increase because of a transaction, then that entry is to be put in the debit side. That should also be done for expense because they are treated as similar to asset. Therefore, if expense increases, it should be debited, whereas when revenue increases, it should be credited because it is like a liability. That is the reason why we have sales being a revenue, it is treated as a liability. When the liability increases, it is credited to the account. Similarly, when revenue increases, this is credited to sales, whereas expense is like an asset. When its value increases, like an asset increasing, it is debited. Similarly, here the expense rises, therefore, it is debited, whereas this is credited. Now, we have introduced quite a few terms. Let us give proper examples. First of all, we sometimes use a word corporation. Is basically a legal entity and is owned by stockholders. If Hari of course is only one owner, but there can be a situation where there are quite a large number of owners graphically or geographically distributed, and this usually called a corporation. Assets is any economic resource that is expected to benefit future activities. Basically, an investment that the corporation makes to generate, to be able to generate products and services for making profits, usually profits. And liabilities are entities' economic obligations to outsiders, meaning non-owners. Equity, as we have already seen, is the claims against or interests in the assets. and when we say owner's equity, it is the excess of assets over liabilities. So, assets minus liabilities will be the owner's equity, which is same as paid in capital plus retained earnings from the equation that we had shown earlier. Stockholders equity, it is the owner's equity of a corporation, because there are large number of owners, not one. So, we sometimes call them stockholders equity. Paid in capital is the amount invested in the beginning when the corporation starts, the ownership claim arising from funds paid in by the owners. Some more term also we have now introduced. Retained earning, it is the ownership claim arising from the reinvestment of previous profits. So, basically in our earlier example, 3000 rupees was basically the profit out of the sales, but Hari, the owner, did not take that money to his own pocket. Instead, it remained with the company. So, it is reinvested with the hardware shop. So, it is reinvested. So, that is the ownership claim of Hari, that is called retained earning. Accounts receivable, also called debtor, is the amounts due from receivable from customers. So, that means suppose that I sell my goods to customers on credit, then this amount is receivable from the customers, amounts due from customers for sales on open account. Open account means on credit. The opposite is accounts payable, which example we had already considered, and that is the also known as creditor, amounts owed to vendors for purchases on open account. So, Hari bought goods on credit for 30,000 rupees. So, that is accounts payable. Revenue is the owner's claims arising from the delivery of goods or services, and expense is decrease in owner's claims arising from delivering goods or services or using up assets. So, in our case, in Hari's case, 7,000 rupees worth of goods were sold out for 10,000 rupees. So, 10,000 rupees is the increase in the owner's claim, but that claim was reduced by 7,000 rupees, which is the cost of the goods. So, expenses are always subtracted from the revenues. Profit, also known as earning or income, is the excess of revenues over expenses. So, these terms we have now given formal definitions for you to understand. Now, here we would like to introduce to you also a very important concept known as accrual basis, in contrast with cash basis of accounting. We had considered an example of Hari's hardware shop, where he bought goods worth rupees 50,000, 20,000 he paid cash, but 30,000 he did not, he bought on credit. So, what we did, this is what example I am saying, Hari sells good, this is of course sells good worth rupees 20,000 for 30,000 all on credit. This is the reverse example. Now, here revenue is used in the current month rather than in a future month when cash will be received. Now, he did not receive cash. This is the example when Hari sells goods worth rupees 20,000, but all on credit. So, he will get this amount of money later in some later month or at a later date, but his inventory position comes down. Still, according to, if it was a cash basis, then he will not show his sales as rupees 30,000. but on an accrual basis, when a transaction has actually taken place, whether or not cash changes hands, we shall show sales as rupees 30,000. That is the accrual basis, and in accrual basis we show sales as 30,000, in cash basis we do not. Accrual basis of accounting recognizes the impact of transaction on the financial statements in the periods when revenues and expenses occur instead of when the company receives or pays cash. So, here his revenue is used in the current month rather than in a future month when cash will be received. A second example is Hari could not pay the rent of 2000 rupees in the current month, he would pay it in the next month. Here in the current month, rent is taken as an expense and is recorded as accrued expense payable. We have shown this here. The first example is that he sold 30,000 rupees worth of goods, but all on credit. Now, here although cash has not come, has not reached Hari, we are still showing sales having taken place and we are crediting it as a revenue, putting in the credit side. Sales 30,000 we are showing and expense we are showing 20,000 because the cost of goods sold was 20,000. So, cash has not actually exchanged hands, but we are still showing this amount, and at the same time we are maintaining another account, accounts receivables, that this amount has not been received by us, by Hari, therefore, by the hardware shop. Therefore, this account is an asset and it is therefore shown on the debit side, 30,000 rupees. The second example was that Hari could not pay rent of 2000 in the current month. So, rent is an expense. It is shown as an expense in this month's account 2000 rupees, but at the same time we maintain another account saying accrued expenses payable. It has not been paid, we have to pay later, it is a liability, and since it is a liability, the rent is shown here as 2000 rupees. Now, look at these examples, the cash account is not at all involved because cash has not changed hands, yet we maintain the account as if the transactions have taken place in this month, and this basis is called the accrual basis compared to the cash basis. So, friends, today we introduced a very important concept of accounting, of how to actually keep your accounts. So, we initially talked about account, we introduced journal and we introduced ledger, then we gave various examples and showed how different accounts are to be maintained. An important thing is that whenever a transaction takes place, there are always 2 or more than 2 entries. They require debiting or crediting. Debit is the left hand side of an account, credit is the right hand side of an account. If that account is an asset, the debit side means entry means that the asset value will increase, the credit side entry means the asset value will come down. The reverse is the case if the account is a liability. If an entry is made in the debit side, it means the value decreases. If it is made in the credit side, the value increases. And a very important concept of accounting is the accrual basis, which says that whenever a transaction takes place, makes the entries not waiting for actual exchange of cash. We shall elaborate on these points and use these concepts in both costing as well as financial accounting later. Thank you.